Hi there. This is Colin and Adi's podcast on 50 years of modern oil trading again. And today is 29th of October, 2025. We are going back into 1980s, but at the moment it's still 2025. And we have a great pleasure to welcome a friend of ours, an old friend, Colin Parfitt, who was with oil major Chevron for 30 years in many roles. Probably most interesting to us at the moment, he was also president of supply and trading for a period of time. So, Colin, welcome. And you know what? If you could please just do a little introduction in your own words, which I think is always the best.
Adi, thank you. And look, Adi, Colin, really nice to be on with you. I'm Colin Parfitt. I've recently retired from Chevron. I worked for Chevron for 30 years and worked for Shell for 10 years before that. And I guess, relevant to this program, I started trading crude oil with Shell in the late 1980s, moved to Chevron as a crude oil trader in the 90s. And then with Chevron, I moved to the United States and I did a variety of jobs, some in trading, some not, but headed up the trading group for Chevron for 6 years and then midstream after that, which included trading. So I've got quite a long period of time thinking about the oil industry. And so a couple of thoughts is for Adi and Colin. Firstly, I loved your book. You did a great job of talking about it. And then Adi and I were just chatting, before we went on air about how long we've known each other because, it's 35 or 40 years because with both Adi and Colin, I remember visiting them in Canary Wharf before the Jubilee line was built, which was in 2000. So we're talking 80s or 90s. So we both, the three of us have known each other for a long time.
Many years of light rail.
Exactly.
Absolutely. And now, since we started that, well, going back to sort of 1980s and early 90s, trading was very different, Colin, wasn't it?
Oh, look, really different. And I mean, there are some things that are hugely different. I mean, the first thing maybe to do is going to wave my iPhone around, but technology was different. I mean, one of the key things, if you go back trading in the 80s and 90s, is you worked in an office. So you came to an office and work and your information was there. And that's how you knew what was going on. And once you left, you were essentially done. I mean, we were early days of mobile phones. And so if you were lucky you had one, they were like a brick to carry around, but there was no go online and follow up messages and see, so none of that. So it was a very different environment than we're working in today.
Yep. And the Brent market was a little bit different. It was quite linked. Colin Bryce would know very well. Very linked to WTI.
Yeah, it's you just mentioned about the phones, and it reminded me actually of something because way back then, if you remember, both of you, a Tuesday night used to be stats night, and round about 9 o'clock you'd get the API stats and there'd be a reaction, and you would be hoping to trade some Brent, but of course there were no phones. Yep. So I always remember on a Tuesday night I would sit in the local cricket club having a beer. And I had given the telephone number of the payphone in the cricket club to a broker in New York, and I would wait for the payphone to ring, and then do some trades. Having a pint of Guinness in the other hand in the local cricket. I mean, it was kind of that sort of thing that you did that people today would just kind of recoil at altogether.
Back to Colin, I was just going to jump in because I love the story, and it reminds me when I joined Chevron in the mid-90s in London, and it was a bit before the time I worked there. But I mean, the traders there were telling me the stories of kind of going back, a bit far into the 80s, where the Chevron crude group in London was essentially called a small satellite group. Their main office then was in their main trading office in San Francisco, which is just interesting in today's world. But at the time, if they wanted to do something like trade a Brent cargo, so what were the time we called 15-day Brent, they would phone San Francisco and say, we want to buy a cargo. They would have to wait overnight to get a message back. And this was all when it was trading fixed price. So the difference in today's world where you're watching screens and you've got all these, algorithmic traders watching all these little movements to going back 40 years where you were doing a essentially a fixed price deal over 2 days because that's how long it took to get the authority. The world has changed a lot.
Unbelievable. And then just to finish my story about the payphone, of course, if the stats went against you and you had a distressed cargo in your hands, you always just called Andy Hall because
Oh yes,
he
exactly.
was
Andy was a buyer,
to take
and Andy was
cargo,
not.
your cargo from you. But yeah, it was a very different time. I always recall, and you tell me if you think I'm right or wrong. I always recall Brent very much following WTI. So nobody really did anything serious until the Merc opened in the early afternoon, and then whatever happened then even though kind of Brent was always portrayed as the international crude oil benchmark, which it eventually became post NYMEX. Back in these days, I thought NYMEX led the way all the time. I mean, is
Yeah,
that
no, Colin,
recollect?
I have the same experience. I mean, I kind of think about trading days. The trading day in London started, I mean, really getting going about 4 o'clock in the afternoon. It was really when the US got going, Europe got going. But I mean, I'm intrigued because, more recently when I've been talking to traders, they kind of give me a funny look when I explain how I learned Brent and WTI, which was essentially, to your point, WTI led. And because of, and again, you both do a good job of explaining this in your book, is that you have futures contracts, physical delivery. Brent was added to part of the WTI contract. So essentially, as traders, you would watch where was WTI, where was Brent. Could the freight take you from Brent to WTI? So your maths really was, Brent plus freight equals WTI, and if it got bigger than that, barrels moved across the Atlantic. It's today, the world's completely flipped today. Whereas, and we've now got WTI as part of the Brent contract. And Addy, I know you did a whole bunch of work helping for that to happen. But and essentially, it's now the other way round, where Brent leads, and you're looking at WTI plus Brent, and can you get into a Brent contract? So it's really interesting how over 30 years that has completely flipped around.
And interestingly, talking about Brent, I had a very lovely lunch yesterday with my ex-boss from Morgan Stanley, Nancy Kropp, who you may well remember. And she was one of the founders of Morgan Stanley's oil business, and her husband, Tom Galdi, who was a broker and trader in New York in the very early days of the market place. And we're talking and having great stories. Anyway, Nancy related this story to me about when she joined Morgan Stanley. They had brought on a chap called John Shapiro, who had been with Conoco, but also a 27-year-old called Mark Crandall, who had been a rising star within the bank. And despite being a comparative religion major, he was absolutely able to understand the science and the techniques behind trading. And he asked Nancy, she told me this yesterday, to explain to him how Brent worked. And he sat and he listened as she explained the complexities of the idiosyncratic thing that was Brent. And she said he just sat there and then he said, "We're going to change that, Nancy." And that's exactly what the Wall Street refiners, as they were, kind of did. And he, Mark Crandall, who subsequently, of course, has gone on to be a major player in the development of oil markets in many ways, was front and center behind that change. Just an interesting little aside.
No, Colin, I love it because you're exactly right. When you kind of the Wall Street refiners and you're with Morgan Stanley's, one of them came in. It really helped with liquidity. It helped with really thinking about options. Things like what called data to paper. Don't get too jargonistic for people, but really figuring out some of these things that were not massively well hedged, managed, financialized might be the right word, monetized, probably a better word in the oil industry. It gave a whole bunch of liquidity around that, and it enabled really trading in a whole bunch of those different, or what you'd call today, differentials. So, quite an interesting time. Hey, look, I was also thinking, because I talked about that flip of, TI over Brent and Brent over TI, and those are probably the bookends. That there was a piece in the middle where it didn't work as well, which was when, I guess, we're the early 2010s, where WTI got really cheap relative to Brent. And this is when, what was happening in the US is the Permian was growing fast. So you had crude supply suddenly increasing in the US. The US had the crude oil export ban, which was a concept from about the 1970s and didn't really matter much to them at the time because US production was going down. And so you then you had a period of time there where you had a massive dislocation between Brent and TI. And essentially it's because there wasn't this relief mechanism to move WTI into the world market. So WTI essentially got landlocked, massively undervalued. So look, in the US, I was at the time heading up Chevron's trading group, and I was doing work and traveling up to Washington, D.C., trying to deal with, congressmen, women, senators, trying to explain, why this was a bad thing. I mean, for economists around the world, it's most fundamentally free trade, and, you want things to find their natural home. But it was really hard because there are concepts that people in the oil industry automatically get that aren't that obvious. And one is grade differentials or quality differentials. So I use the right words here, is that crude oil isn't crude oil. WTI is like crude oil. A lot of refineries, particularly on the US Gulf Coast, are built for heavy crude oil. So there was a logical exchange to go on where light crude flowed out of the US, heavy crude flowed in, ships would pass over the night. But people really didn't understand that. And then the thing that just intrigued me, and I'll call it lack of energy literacy amongst politicians. And you could argue that's part of our issue is the industry of not explaining. But I mean, people would ask me some really strange questions. I mean, at the time, not everybody understood the difference between a crude export ban and a products export ban, which there wasn't. They're very different things. In Washington, D.C., I'd been asked about things like diesel, and I was asked, well, why didn't we drill for more diesel? I'm thinking, okay, there are some real basics here that you haven't got. But happily, there was a kind of a coalition of the willing, and I think in about 2015, the crude export ban got lifted, and again that's enabled those markets to connect again. But fundamentally, there was a time when they didn't connect because there wasn't a mechanism for them to connect.
Yeah, that reminds me very much of one of my old bosses in the United States, who shall not be named here, who once said the market was going down relentlessly, and I think Colin Bryce would recognize what I'm talking about. But Bryce, I'm not going to mention the names, but this former boss of mine said, like, to hell, why don't you buy me some of those shorts?
Oh, yes, yeah.
They were making money, so why don't you buy some? Anyway, so there was a lot of interesting stuff throughout your career. I understand through an earlier conversation that you were also involved in something that Colin Bryce and I were looking into in the book, a very fascinating period of oil for food program.
The oil for food program. Yeah, so so my early days in Chevron, I joined in 95. I went to Baghdad to sign Chevron's first contract under oil for food. So, I mean, context for everybody, if they remember, first Gulf War would push Saddam, the Allies had pushed Saddam out of Kuwait, gone back, sanctions on Iraq. They had a population struggling. So the United Nations put in this thing, oil for food. The idea was, Iraq sold the oil, it went through a UN program, and food got distributed. So a couple of issues. I mean, for me, very memorable because I went to Baghdad, but at the time, and again, if people remember their history, there was a no-fly zone over Iraq. So you couldn't fly in and out. So I flew into Amman in Jordan, basically had a driver and did a 10-hour drive across the desert into Baghdad. I don't recommend that as the most scenic drive if everybody wants to do it. I stayed in the hotel. Look, I forget the hotel name, but again, people might remember. It's the one that had the big picture of George Bush, first George Bush, on the doormat. So you actually had to walk over him to go in and out of the hotel. and again, for people in today's world where a trade is done by a click of a finger, the reason I did all of that is to get an oil contract from Iraq. SOMO, I think they still call them State Oil Marketing Organization, the Iraqi, state sales entity. You had to physically turn up to physically sign the contract. So anyway, I went in, we got one for Chevron, we're using this oil on its West Coast refineries. So, okay, in, out, got the deal, it was good. But then things started getting interesting, got very politicised. So the Iraqis decided that the US weren't their friends, so they didn't want to give contracts to US companies and British companies, but they were friends with the French. So as Chevron, we used to buy from Elf and Total, who got contracts. So, okay. And then I'll just say it got weird. And what happened is that lots of small companies were invented to have Iraqi contracts. And look, there was and it's quite interesting. Look, for people who've traded, and I'm sure Colin, Addy, you're going to relate to this, is you're on a trading floor, and if I go back to the time, not only we have phone lines, we had receptionists who would shout, "Hey, I've got Colin from Morgan Stanley on the phone," and you say, "Yep, I'll take it," and then they'd say, I've got somebody who you've never heard of and coming on the phone. You're thinking, not sure that this is going to be, we called them flakes, but it'd be somebody inventing a story. Generally, they knew a prince in Nigeria. So anyway, you would screen all of those out because none of them were real. In the case of your food program, some of these people were real. I remember, look, I'm sorry, this is a long story, but I remember a meeting I had in a hotel in Mayfair, and I was with a colleague, and there was this guy I'd never heard of, and this company I'd never heard of, and he said, "I've got this contract for food," and we were thinking, didn't understand anything about the oil industry, and we were sitting there thinking, this is not real. And we said, "Well, no, you need a contract, and it's written like this," and he kind of opened his briefcase, and he pulled one out. And so, so contracts of oil were basically given to companies that were frankly made up just to get the contract. And the real deal was the OSP, the official sales price of Iraqi crude oil, had started to get low. And so there was a big premium, which started as nothing and then moved. Found out was that money was essentially being siphoned off and going into the Iraq. So it was all a big scam, essentially, with these countries put in. Just interestingly, United Nations run, United Nations had oil industry overseers. I remember an ex-Shell and ExxonMobil people were in there, but the scheme was, look, it got a whole bunch of bad press, and it got bad press around trading companies skimming off money and giving it back. But actually, there was kind of part of the design of this program that led it that way. Look, I apologize for that being a bit of a long story, but interesting time.
No, well, that's a great story. And you know what? We spent quite a bit of time, Colin, Bryce, and I, discussing, and we tried to keep the book as light as possible. But essentially, the idea is that every time we have seen in our careers the government getting involved with prices,
Yep.
you always get some sort of horrible situation. So, currently we still have the sort of following the Russian invasion of Ukraine, we have a situation where the United States impose these price caps, which don't really work. But I mean, what do you think about that? Well, I think they don't work.
No, they don't. I'm smiling because I remember a story of, it was a few years ago when the US put on the first price cap for Russian oil. And I was having a conversation with, I guess I'd call him a consultant, but one of these consultants who's ex-White House and has kind of moved into a job where he's doing consultancy because he's got ins with the White House. And this was just announced, but it was in the press. And I was sat next to him and I was saying, "Look, this won't work." And he kind of gave me some comment, and I said, "No, it really won't work because of this." And he said, "Colin, you don't understand." And I said, "No, look, really, it won't work." And I was explaining to him why it won't work. He said, "Colin, I've been in the White House. They're not expecting it to work." And look, the way I would describe this is at the time, and look, and particularly in the United States, and I lived 20 years there, but you've both travelled there and you get it on the news. Is the price of gasoline, so petrol here in the UK, is a hugely political thing in the US. If it goes high, bad, low. So the White House were really paranoid that if Russian oil came off the market, supply and demand would kick in, less supply, and essentially for the same demand, price will go up. Classic economic theory. So they understood that there would be a redistribution. They understood that they wanted to do something, to be seen to do something. but they didn't really want anything to work. And so they designed a scheme that, on anybody in this, well, that makes no sense. And you're struggling. And then you think, oh, it was designed to make no sense. It was designed to look like it would do some good, but without fundamentally taking Russian crude oil off the market. So I think that's what we see at the moment. If you look at Russian crude oil post Russia, Ukraine, and post all the various sanctions, the volume is about the same. The distribution is different. So essentially all that crude now flows to, along India and China, it flows east. It used to flow naturally to the west. So getting the way, I described it to people in two ways. It's a redistribution effect. Markets work because it's figured it out. I would argue the world is slightly worse off by transportation, because essentially that crude oil from Russia that used to flow to Europe, short transportation, cheaper cost, now flows to the to Middle East and Asia, higher cost, and it's backfilled by a higher cost transportation. So the world is slightly worse off, but fundamentally supply and demand have stayed the same. So roughly the price level stayed the same.
I think it's an excellent example, isn't it, of the efficacy of merchanting. That value-added function that the trading part of the majors and the big
and the trade,
beetles and trading companies do, they get very well rewarded for.
Yep.
Open a debate about whether the reward, the size of the reward, is consummate with the commensurate with the value added. But when Russia's situation arose, stuff happened, and these people made it all okay. And
no, absolutely, I agree with you, Colin. Actually, if I go back on my history, when Russia, Ukraine, the invasion happened, sanctions came on, the gas markets took a bit of a while to readjust. Gas shot, and essentially, fundamentally, why is that you had gas on LNG ships, but you couldn't quickly get it to Europe, and you didn't have all the import terminals infrastructure, so that there was a lag on that. Gas prices went up. There was a bit of a lag on crude pretty quick. By the time they introduced a products ban, and we saw that coming, I thought maybe there'd be it was almost instantaneous. And it gets because there's all the market signals, and traders, whether they're working for majors or whether they're working for trading companies, they all get the same signals, and exactly oil gets distributed to the right place. So, and I think the way that the sanctions on Russia, Ukraine, the way that flows have changed, but fundamentally, the motorist can still fill up with petrol, you can still flick a switch and the light bulb goes on, really shows how well that kind of that merchant energy industry works.
Yeah. But just briefly sticking, Colin, to the lack of understanding in the United States, I had a couple of just quick questions that occurred to me. First of all, one is sort of, I know you were involved, and I was when I was in Europe. My company was involved in Kazakhstan, so sort of lack of geographic understanding, I think, is absolutely appalling. And before that, if you don't mind, just one other quick question, just very briefly, because you did some LNG, I know, and I did a lot of LNG as well with my sort of team in gastro-marketed trading. I remember the talk of politicians when they were saying, oh, we should basically put a cap on TTF. And we were all going, oh my God, what are they talking about? You're hedging your physical with TTF. Imagine putting a cap on your hedges that will completely go down the toilet versus physical.
Yep.
So just
no, look, I get, but so I'll kind of do those, and I'll try and be fairly brief. But yeah, so I spent a lot of time in my last couple of roles in Chevron in Washington DC, talking to elected officials. And when I first went there, my public affairs department used to give me these big briefing packs. And I kind of got rid of all of those because what I figured out is with some exceptions. Look, I don't give blanket. There are some very bright and intelligent people who know, but there's a swathe of politicians. And look, my number one talking point, Addy, was generally Kazakhstan's a landlocked country because here was the Chevron perspective. So Chevron have got Tengiz Chevron, big joint venture in Kazakhstan. Kazakhstan, friendly state to the United States. The only way out of Kazakhstan is through a pipeline that goes through Russia. And so when they were doing sanctions bills, the concern was, are they going to put a sanction on that pipeline? And so politicians say, well, send it somewhere else. send it to a different port, and you get to, okay, firstly it's it's landlocked, it doesn't have any ports, you've got to explain that bit, and they think, well, okay, so where else do you want to go? Because you can go through China, you can go through Afghanistan, you can go through Iran. I mean, if you do a map, Kazakhstan's not in it's in a geopolitically challenged neighborhood, if I used a euphemism. It's hard. So yeah, but fundamentally, the lack of geographic knowledge is just intriguing in the US. And then, yeah, LNG. Well, LNG is interesting because it's Colin and Addy, I mean, we all worked in oil markets, and a lot of your book was about how oil markets moved over the last 40 years. LNG is moving that way, but it's way back on the curve. And look, it still intrigues me that you said you've got two big pricing mechanisms on LNG, which are, they call it slope to crude, but essentially a percentage of crude or a market price. And Andy, is exactly your point. I mean, the market prices, the problem is they're not deep enough. So people do the oil one, but the problem, you get massive dislocations where the same cargo is worth double the price if you priced it off a different index, and it's nothing to do with quality. It's the same stuff. So some of that is where we saw, certainly post Russia Ukraine, massive trading profits in some of the trading companies and the majors. If you get the right side of that, I mean, it's just unbelievably large amounts of money.
You literally took words out of my mouth, because obviously the likes of Vitol and Shell, I mean, they've had some humongous profit. And if you have right optionality on those prices, and they're not particularly correlated necessarily, gas and oil price, and if you have optionality on uncorrelated assets, well known, as Colin Bryce would know from his banking days, that's really a jackpot you can hit.
No, absolutely. Look, and I'm going to look to be transparent for both you and listeners. I mean, so you can. I learned some of this back in the early 2010s when I was heading up the trading group in Chevron, where we lost some money on that because of that lack of correlation. Because if you were at the time, the LNG, we were making some trades, we were buying fixed price LNG, and you couldn't hedge it because there wasn't the volume. You couldn't get half a cargo off, and now you've got fixed price. You're trying to hedge with Brent. Brent's not necessarily correlated to the gas markets, so you can get yourself stuck. But if you can build, if I'm doing jargon for everybody, I know the two of you know, but if you can build a trading book, and then you can capture all that optionality, it's just an enormous upside.
Yeah, tell you, I'm interested in something else. It's a separate subject, Colin. I mean, you worked in Shell. And we represented, to a certain extent, the differences between Shell and BP in our book. It was keyed off the fact that so many of the senior BP people have gone on to be major figures in industry across the UK, and whereas in Shell, that's never been the case. And I guess my feeling always was that BP were decision makers. They had a culture right to the top, which embraced trading. Shell were a big bureaucratic overlapping organisation with a kind of vacuum of decision making, and all difficult to see who to go to do what. How did you feel about Shell versus going to an American major, Chevron?
So, Colin, firstly, my observation, I think you accurately describe it. And some of it's how I remember it. So, full transparently, I've not worked for Shell for 30 years. But if you go back and you describe it, it was like the Dutch civil service. Which was really a bunch of the heritage. It absolutely was big bureaucracy, very decentralized. And some of the again, I go back between 30 and 40 years, and the trading companies loved it, because at the time in Shell you had Shell International, but you also had Shell UK, Shell Germany, all doing their own things. And the trading companies and people would get in between, and they would they would buy from one Shell entity, sell to the other, make some money, because of relationships and contacts that Shell didn't have internally. So just interesting. At least Shell did see that, and they centralized. So I think there is a difference between where they were, where that culture was 30 years ago, and where it is today, because they've moved all that in. So now Shell Trading really does do trading for everybody. They've got an enormous book with lots of optionality, and they drive their trading through that. So I see a difference then now. I'm between. But so to your question, when I left Shell, which was very, I call it Dutch civil service, went to Chevron, which was very Californian company. So I'm doing some stuff now, which is I've got eras and companies, but I'll give you some for examples. Is in Shell, you would always refer to anybody. I mean, firstly, I'd never see the senior leaders. I would never see the CEOs, and you'd call them Mister. In Chevron, I'd bump into the CEO, and you'd call him by his first name. Look, again, if I did another Shell story, it's fun. Just before I started trading at Shell, so this is mid 1980s, I was working at Stanlow Refinery, which is Ellesmere Port up near Liverpool. And when I joined Stanlow Refinery, and I was running a lubricants blending plant, so not trading industry, running a lubricants blending plant, but they had 5 different levels of canteen, so for lunch, depending on where you were. So you had senior so I mean, if you just think about that stratification of the workforce, and I went to Chevron, and you'd go to the canteen, and the CEO might come and sit next to you. I mean, it was so the cultures were there quite different from the start. And then, look, I mean, if I kind of moved slightly to, one of the things you do observe, though, is that the Europeans, if I just go back to trading, the Europeans have bigger merchant trading arms than the US companies. So, I headed up Chevron's trading group. It is not scaled as big as Shell. It's not scaled as big as BP. It's not scaled as big as Total. There was a while where Exxon didn't bother at all, and they're now trying to get into the game. So there's a different culture. One of the issues that kind of sits behind it is, what do shareholders value? And so this is hard. So I spent a lot of time in my last role dealing with Chevron's shareholders and dealing with analysts who follow the stock. And again, look, I'm not going to be negative, but analysts can be relatively simple. And what they like is they like a model of how to project your earnings. And so you can get, if they can do a simple model, which is how much oil do you produce? What do you think the oil price is? How many refineries do you have? What do you think the refining margin can be? And they can calculate a number. And with trading, they struggle to do that. So it's okay if you give them an add-on, they can get that. But what they really struggle to see is, how can they see that grow? How do they get volatility? And because of it, if you look at the majors, none of the majors disclose financially their trading earnings. Shell, BP talk about it a bit. Look, what they do is they can confuse the market. For example, I think I've read this recently, I didn't check this morning, is, Shell give updates, and I think they updated that LNG was going to be better than normal and oil was going to be worse, something like that. I might have got it the wrong way around. But if you're an analyst, you've no idea what that means, because they haven't given numbers, they've just given ranges. And if you look at the trading companies, the big merchant trading companies, the only one that I think of that I can is Glencore, that are public. Everybody else is private. And Glencore, in their financial results, they meld they don't segregate their trading from their mining. And so the result is they get rated as a mining stock. So one of the issues you have kind of for, if I kind of did classic economic theory, it would say, if you make more money, you'll get valued higher. But actually, when you poke down into how do people value energy companies, they like trading if it's a plus. They don't necessarily like it's a minus, and they don't really understand. And so they struggle to put a multiple on it. So, transparently, a view that we had in Chevron is you can make trading money, but don't talk about it. So it's in your upstream or downstream sector. That probably gives you a higher multiple than if you talk about it as trading. Now, I mean, that's a theory, it's a bit of conjecture, it's hard to know but it is interesting that with this business that we're all talking about, there are lots of massive private companies, not least because of the money they've made recently. But there really isn't a very good example of a publicly traded trading entity.
And all these private companies are based in Europe, London or Geneva. And it's interesting, isn't it? The US is, big oil, but not big oil trading. Neither in the majors. I mean, certainly Shell, Mobil, etc., have had some sort of trading businesses, but not like BP or Shell.
Not scale. And some of it you get.
Glencore, and I think it goes back to the thesis that we have had in our book, which is that this trading business, this oil trading business, developed as a social construct.
Absolutely.
And it developed because of the contiguity of people and place.
Yes.
And it was London and everybody together, or
But I agree with that.
and everyone together. And it wasn't New York and it wasn't Houston, you know. And
Yes.
so I think you get that sort of intellectual crossover when you have all these folks together, and you know, it takes you back to Alfred Marshall's economics, doesn't it? Really? That,
No, I completely agree with your premise. Is that, I mean, so I do believe that. I think your thought of the social context, and you know, particularly if you go back where it was more about relationships and less about the screen, and so London developed. But if I went back to the US today, it's getting more like that, because if I went back, and I mean, so look, I mean, you know, if I think both, you know, Morgan Stanley and Texaco, when you used to work there, they were New York. There were a bunch of New York stuff. There were New York traders. You know, I think I articulated when I moved to the US in Chevron, I was trading in near San Francisco. There was a West Coast trading club. If you say what's happened to today is essentially all of that in the US is consolidated into Houston. I mean, I'm saying there aren't none, but there is virtually no. There used to be a New York trading business that's kind of come into Houston. You get to the why. It's, to your point, it's about, there is still some, even in an electronic trading world, there is still value in personal relationships, particularly in the physical, in the merchanting, you know, the banking, the financial side, a little bit different, but in that, contact's important. So, you know, although you know this might be a bit behind, I observe the same thing happening in the US, is that consolidation into Houston as a hub, and it's really because that's where everybody else is, and you can go and have breakfast meetings, lunch meetings. And it's a bit the same as London. When I was recently working in Houston, people could phone me up and say, "Hey, Colin, can you meet for coffee?" And you could, because everybody is there together, and it's an easy thing to do.
Yeah. Just to link it back to the book a little bit, actually, Colin, Bryce, and I, we did discuss it in a couple of chapters. Actually, what you were saying, one is trading around the assets. And I think assets are very, very important. What you're saying
Yeah.
about Glencore, what you're saying about a
Yep.
lot of other, even Vitol, and
Yep.
in the old days, Fibro had Fibro bought a
Yep.
refinery, come by chance with Vitol and so on. And trading around assets is very, very important. As you know, Colin, you know, getting that information from the system.
Absolutely.
And actually, some of the majors, actually, I know very well from discussions, BP, for example, to this day, they recognize that part of that trading profit comes from the assets, and they kind
Yep.
of assign it to the assets as well. The other point
Yes,
that you
I agree
mentioned,
with
I
that.
think, is also very, very good, is the point about people still being very important, because Colin, Bryce, and I did some research, and it's in the chapter called Paperboys. Even these guys who are trading, in many cases, algos, they still go on ski trips and golf outings, and they go out with brokers. It's important. And to this day, what's really interesting, that they actually, the pure traders, they prefer to have box where they talk to brokers rather than trade the screen, because screen is a lot harder. Broker is an important friend to a trader. We all know that.
No,
So they will bring
yeah,
you that deal if you
agree.
have a good trader. So
Yep.
exactly,
No,
places and people.
personal relationships are still completely, and particularly in the physical world where you're moving stuff around. But I get your
As
point.
Mark,
Even in the
yeah,
paper world, it helps.
as Mark Rich said famously, it's not the deal, but who brings you, the person who brings you the deal. And
Absolutely.
gents, I'm sorry, we're a little bit out of time, which is not a problem. It looks to me that there's no doubt that you're going to come back to our podcast again at some stage. But for now, I think this will have to do. So we thank you very, very much.
Thank you,
This has
Colin.
been absolutely brilliant catch up, chat, and I hope that others find it useful. Thank you very much.
Andy, Colin, thank you for inviting me on your podcast. It's a pleasure talking to you both, and reconnecting. And also, both of you, well done on writing that book. I thought it was a great book. And look, if anybody's watching or listening and hasn't bought it and read it yet, I recommend it. It's a thoroughly good read.
And now that you're relocating down to Charnmouth, I think Addy and I will be down with our little geology hammers.
Come and join the kids on the beach,
the
hammering at the rocks.
Jurassic coast, and trying to see what we can find down there. So expect us.
Absolutely. Thank you.
Colin,
Goodbye.
Andy, thank you so much.